Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Paccar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 57 billion market cap. They're trading at 107 a share, and they have 528 million shares outstanding. I never heard of this name, and they have a 57 billion market cap. There are so many big companies out there we haven't heard of. Hopefully that's why you watch my channel. Paccar designs, manufactures, and distributes light, medium, and heavy-duty commercial trucks all around the world. They have three segments: truck, parts, and financial services. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look at this growth from 2021, 550 million, and nearly tripled to 1.6 billion. Then it goes up 79% to 2.9 billion, up another 25% in the trailing 12 months. Amazing growth. Margins are getting really solid, 10%. Free cash flow margin is free cash flow over revenue. It's a percent of the revenue that's converted into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also goes up a lot, from under 2 billion to over 5 billion. Look at their margins improving each year from 8% to 14%. Revenue is a sales for the company, and that grows nicely from 24 billion to 35 billion. But look how much more their net income and free cash flow have grown. They're really doing a great job at managing expenses. Revenue per share is 67. Share price is 107. Price to sales is share price over revenue per share. So it's about a 1.3. They offer a dividend of a little over 1%. That cost them $633 million, which they can easily afford with 3.7 billion of free cash flow. So they might raise that dividend. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4, that's 82 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $74 billion. We divide that by 500 million shares. And we get a calculated stock price of 140. They're trading at 107, so they're trading at a 24% discount. It's a buy according to the model. This looks like a great stock to own. Their free cash flow growth is phenomenal, and the forecast is for them to grow into the future, almost 5 billion by 2027, which is a fairly modest growth. Their growth from 2021 to the trailing 12 months is like 500%, but their growth from 2024 to 2027 is not even 20%. If they can hit 6-7 billion of free cash flow by 2027, which I think they have a good chance of doing, it could 3 or 4x this stock. There are 27 companies in the same industry as Paccar, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 1.3 billion. These are the investments in property, plant, and equipment. Debt to equity ratio is equal to the average, a little worse than the median. For every dollar of equity, they have 80 cents of debt. They pay a good dividend, a little lower than the median. They generate a lot of free cash flow. They're third in market cap, pretty far behind 1 and 2. I'm sure most of you have heard of Caterpillar and Deere. I definitely have, but I've never heard of Paccar before last week. They're trading at 3 times book value, 11 times earnings, which is a really good multiple. It's equal to the median. 15 times free cash flow, right at the median average, and 1.6 times revenue. So I was off before. I said 1.3. What was I thinking? They generate a lot of revenue, 35 billion, and they're still growing. Their 5-year annual revenue growth rate is 8%. Double the median, a little less than the average. If you put $10,000 into this company 10 years ago, you'd be really happy at $36,000 today. That's a 14% annual return, a 260% total return. Let's take a look at their income statement. This is the first quarter of 2024 versus the first quarter of 2023. Their revenue was 8.7 billion in the first quarter. 8.2 billion trucks, parts, and other. 500 million financial services. They're profitable in trucks, parts, and other. 8.2 billion minus cost of revenue, 6.7 billion, minus some operating expenses. So their total expenses are 6.9 billion. In financial services, they have 500 million of revenue, 400 million of expenses, so their operating income is 114 million, less than last year. Their net income is up a lot, $1.2 billion compared to $730 million. It's mainly up so much because of trucks, parts, and other. Their revenue went up slightly, but their expenses went down quite a bit. Earnings per share is earnings over shares outstanding. That's 228. Last year was 140. They did add some shares. They went from 523.5 million to 524.9 million. Let's see if they give more detail on the revenue. Here's a breakdown of their truck sales. Of the 8.2 billion, 6.3 billion is directly from the sale of trucks. They generated 236 million from warranties and operating leases. Part sales is 1.6 billion, and then dealer services is 50 million. So it's up in every single category. Winch sales is up from 13 million to 18 million. Winches are like ropes that you turn to pull something in. They're pretty common on ships. You turn a lever to open up the sail, but they use it for trucks. These are the types of winches they sell. It can be really helpful to have a winch in case your truck is stuck in the mud. Here's a breakdown of their truck sales by location. 4.3 billion in US and Canada, 1.3 billion in Europe, that's down. Mexico, South America, and Australia, 957 million, that's up. It's up the most in the US and Canada, up 16%. Here's some more info on their financial services segment. Revenue in US and Canada, 200 million, Europe, 144 million, and other countries, 150 million. If somebody wants to buy a truck or a fleet of trucks off this company and they can't afford the entire payment, then they can take a loan or they can use a finance lease just to spread the cost over a longer term. They also generate 71 million from dealer wholesale financing, so they work with dealers as well, and equipment and leases, 206 million. Let's take a look at the statement of cash flows. Operating cash flow went up a lot. It more than doubled from 700 million to 1.5 billion. That's mainly due to higher net income. Their net income went up 400 million. I guess that's also due to lower changes in working capital. In receivables last year, they had a cash outflow of 448 million. Now it's 240 million. A pretty big improvement in trade receivables and wholesale receivables. Also an improvement in inventory. They spent 400 million last year, now 200 million. Since they provide financing and loans, there's a lot going on in the investing section. They have a lot of money coming in and out from loans and finance leases. They did spend 191 million of PP&E, property, plant, and equipment. It looks like they disposed of an asset and received 169 million. And in the financing section, they paid out 1.8 billion of dividends, a lot higher than last year, only 1.1 billion last year. They don't spend much in stock buybacks. They also added a lot of debt, 1 billion of debt. So the cash at the end of the period was 6.2 billion, down 1 billion from last year. In my Excel file, I calculated a much smaller dividend payment. Let me show you the difference. I calculated their dividend payment off of their last dividend paid, which was 30 cents. But they paid this huge dividend in the first quarter of 2024, $3.20. It looks like they had a lot of extra cash flow, so they give a big dividend. They did the same thing last year, just not as big. It was $1.90 last year. Here's an article back in December 2023. The company declared a special dividend, the $3.20 dividend. And they mentioned the company has generated excellent returns due to their premium quality vehicles, strong growth in aftermarket parts and financial services. And since they were so profitable, they were able to invest in the new DAF, Kenworth, and Peterbilt trucks. Those trucks are fuel efficient and have an electric powertrain. It looks like they acquired DAF trucks back in 1996 for 540 million. And that company is based in the Netherlands. And they also acquired Peterbilt Motors, but that was a long time ago, back in 1958. It looks like Peterbilt's sister company was Kenworth Truck Company. Let's look at a company on Simply Wall Street. Its last price, 106, 56 billion market cap, down 1% in the past week, up 35% in the past year. They IPO'd back in 1990, and it looks like they did really well since they started. It did break through $40 in 2007, and then came down to below 15. It's pretty much only uphill since 2008. There were some dips when the market came down, but they came right back up. Their highest stock price ever was 123. That was pretty recently, about 3 months ago. Looks like a lot of people took in their gains and sold the stock, which pushed the price lower. So now it's trading a little above 100. They seem to have a lot of tailwinds. There's a lot more upside potential than downside, at least so it seems so. Simply Wall Street's valuation is 122. They say the stock is 13% undervalued. 19 analysts priced this stock at 121. They also say it's undervalued. Their revenue target for this year is $32 billion, next year $33 billion, after that $36 billion. And their free cash flow forecast is really bullish. $4 billion in 2024, $4.2 billion in 2025, $4.4 billion in 2026. It looks like their debt and equity are always really close to each other. Currently debt of $14 billion, equity of $17 billion. But they do have a lot of cash on their balance sheet, over $7 billion, almost $8 billion. Plenty of cash to service the debt. Here's their dividend yield since 2014. It was 2.4%. It seems to move around a lot. Its highest ever was over 5% in 2019. Then it fell to 2.2% in 2020. I guess my yield is lower in my Excel file because I've been taking their current dividend, multiplying that by 4, then taking that number and dividing it by the stock price. I didn't look back in prior quarters. Most companies have pretty stable dividends, but they pay these really big dividends each year if they have excess cash, which they did the past 2 years. Their CEO's salary went from $500,000 to $1.5 million. It's a pretty big jump. Total compensation $16 million, tenure as CEO 5 years. In the past year, there's one insider sell, no buys. 67% of the companies owned by institutions, 31% by the general public, and 2% by insiders. Their biggest shareholder is Vanguard at 12%, then BlackRock at 7%. Their previous CEO, Mark Pigott, owns 1%, and then a lot of big banks own the stock as well. Their employee count went from 22,000 up to 32,000, so that's a nice growth. The ticker trades on the Nasdaq, Xetra, Deutsche Börse, Wiener Börse, London Stock Exchange, Bulgaria, Buenos Aires, and a Sao Paulo Bolsa. Let's learn a little more about the company. Their two main subsidiaries are DAF, Kenilworth, and Peterbilt. DAF is a Dutch truck manufacturing company. Some of the truck models sold with the DAF brand are designed and built by Leland Trucks. Leland is a UK company. Their other subsidiary, Kenworth, was founded in 1923. They're in the US, in Seattle, Washington, and they specialize in heavy-duty and medium commercial vehicles. Their third main subsidiary is Peterbilt, and that company is located in Texas, and they also focus on heavy and medium-sized commercial vehicles. Paccar is part of the Nasdaq 100 and S&P 500, so I'm pretty surprised I haven't heard of them. They were founded in Seattle in 1905 by William Pigott Sr. Their original business model was the production of railway and logging equipment. In the early 1900s, they manufactured horse or oxen-drawn logging trucks. As the company grew, they got into other types of businesses, like designing air brakes and selling refrigerated boxcars. They also manufactured structural steel that was used in buildings. During the Great Depression in 1930, despite the market crash, the company's earnings rose. But as the Great Recession got worse, the company did start to struggle. They did receive government contracts for steel fabrication for the construction of a bridge in Seattle. Sales really started to grow during World War II. That was due to increased demand for steel used in airplanes, airports, bridges, naval ships, highways, and other equipment to support the war effort. At one point, the company's name was Pacific Car and Foundry Company, but I guess they smushed that all together. Now they're Paccar. After World War II, this company was part of the federal government's mobilization planning program, which meant the company had to devote 100% of its facilities to military production in the event of a national emergency. They were the prime contractor during the Korean War for producing tanks. And then in 1945, they purchased Kenworth Motor Truck Corp. Kenworth had been producing trucks in Seattle since it started in 1923. During the Second World War, Kenworth produced trucks, airplane assemblies, and sub-assemblies for the U.S. military. In 1954, Paccar acquired the Dart Truck Company of Kansas City, Missouri, and also the Peterbilt Motors Company of Oakland, California. DART's main product was heavy off-highway dump trucks and specialty vehicles. Paccar's steel division made the steel used to build the 50-story Seattle First National Bank, and also to build Seattle's Space Needle in 1961. They made 5,700 steel panels weighing 58,000 tons, which formed a major part of the load-bearing walls for the Twin Towers in New York City. And those steel panels were shipped from rail from Seattle to New York City on more than 1,600 rail cars. And this company was the largest contractor of the 13 steel fabricators that provided steel for the World Trade Center towers. And we know how that story ended. I don't really want to get into that. Then in 1970, they created a manufacturing facility in Australia, producing trucks to serve the growing, developing local and Southeast Asian markets. They purchased Wagner Mining Company in 1975, which built underground mining vehicles. They also purchased International Car Company in 1975 and Foden Trucks, a British truck manufacturer. Foden sold trucks in Europe and Africa. They had record sales in 1984 of $2.25 billion. They did close their Kenworth assembly plant in Kansas City. That was in 1986, due to fierce competition from other companies like Daimler and also Volvo. In 1986, they acquired Trico Industries, which manufactured oil exploration equipment based in Gardena, California. And that acquisition only cost them $65 million. In 1992, they purchased a 21% stake in Wood Group ESP that added to its oil field equipment manufacturing. In 1993, they acquired a line of winches from the giant manufacturer Caterpillar. Then in 1994, it began selling in New Zealand for the first time and entered new countries in Asia and Central and South America. By the 1990s, they started selling trucks to more than 40 countries. And at one point, they were one of the largest exporters of capital goods in North America. And this company ranks second in production numbers in the US and third in production numbers globally in big rig truck production. And the company ahead of them is Daimler. Daimler is now called Mercedes-Benz Group. At one point it was Daimler or Daimler Chrysler or Daimler-Benz. I'm sure you're familiar with Daimler or Mercedes, the giant German auto manufacturer. The other major heavy truck competitors include Navistar and Volvo. Navistar is a subsidiary of Volkswagen, and Volvo is a giant Swedish car manufacturer. Volvo not only sells trucks, buses, and construction equipment, they also sell marine products and have a financial services arm. Volvo is the second largest manufacturer of heavy-duty trucks. Their revenue was cut in half from 2007 to 2009. Then just 2 years later in 2011, they had their highest revenue at that point. And it pretty much grows each year. It was higher in 2019 than 2020. But by 2022, they got back to pre-COVID levels, actually beyond pre-COVID levels. So that's the end of the video. Let me know what you think. Thanks for watching.